The Adobe revenue paradox. Adobe just delivered a record $6.6 billion quarter, with AI-first revenue tripling year over year, yet the stock is taking a hit. Wall Street is ignoring the top-line beat because they are staring at an unchanged annualized recurring revenue guide and a leadership vacuum. While the headlines focus on the departing CFO, the real movement is buried in the decision to defer Creative Cloud price optimizations in favor of a massive freemium land grab. This isn't a sign of weakness. It's a calculated retreat from high-margin pricing to defend the ecosystem against AI-native upstarts. Adobe is intentionally suppressing its own short-term margins to secure the enterprise content supply chain before the competition can bridge the gap. This shift from selling individual creative tools to managing the entire content lifecycle is where the actual money is moving. Orchestration over innovation. Forget the latest Firefly filters. The core of Adobe's 2026 strategy is Gen Studio and the pivot toward customer experience orchestration. The company is successfully navigating the AI value trap by moving up the stack from individual pixels to enterprise processes. By branding this the content supply chain, Adobe is effectively positioning itself as the ERP system for marketing departments. They aren't just selling a generator, they are selling the plumbing that connects planning, creation, and delivery across 20,000 global brands. This creates a level of contractual lock-in that a standalone AI image generator cannot touch. When an enterprise integrates their brand intelligence and asset metadata into Adobe's agentic framework, the cost of switching becomes prohibitive. It's a classic infrastructure play disguised as a creative upgrade. The $500 million floor. The skeptics who doubted AI monetization just got a $500 million reality check in the form of I first arranged by. This isn't speculative value. It's coming from consumption-based models like generative credit packs and dedicated Gen Studio contracts. By tripling this specific revenue line in 12 months, Adobe has proven it can convert hype into actual P&L substance. However, the move to double down on freemium Acrobat and Express users shows they are worried about the top of the funnel. They are currently subsidizing high-compute AI features for 90 million freemium users to prevent them from ever looking at a competitor's tab. It's a high-stakes OpEx gamble that only a company with Adobe's $5 billion cash pile can afford to play. This consumption model shifts the risk from the subscriber to the vendor, requiring a constant stream of high-value output to keep the credits flowing. The ERP of Marketing. Adobe's Q2 performance confirms a fundamental transformation. They are no longer a creative tools company, but a business process powerhouse. The strategic pivot toward the content supply chain, backed by $300 million in Firefly revenue, shows that Adobe is winning by becoming the boring, essential infrastructure for the agentic enterprise. While the market frets over the CEO transition and the June 15th CFO departure, the underlying numbers suggest a move toward SAP-level integration within the marketing stack. The decision to prioritize user acquisition over near-term margin expansion via price hikes indicates that management sees 2026 as the final window to lock in the enterprise AI market. For operators and investors, the key indicator isn't the stock price volatility, it's the remaining performance obligations, which currently stand at a massive $22 billion. Watch the Gen Studio adoption rates and the conversion of freemium users into credit-consuming subscribers throughout the second half of the year. If that conversion rate stalls, the aggressive OpEx spend on AI compute will start to look like a liability rather than an investment. Subscribe for more